Stocks, bonds, ETFs, straight out of downtown Chicago.
Welcome
This
to
is
Zacks
Zacks
Market Edge, the podcast about investing in your life. I'm your host, Tracy Reineck, and this week I'm going solo this holiday week to talk about the gold miners again. They're back. I know I promised to bring them back after the last earnings reports, and so I am, because these are buys into 2026. They remain cheap. Gold remains near its all-time highs, and it's holding right around the $4,000 an ounce level. And what that means for the gold miners, as long as they can get it out of the ground, and that's the big issue with the gold miners, is actually mining if they can, and they can keep that production at current levels or even increase production while these prices are at record highs, and then keep their costs down and contained. That's also an issue with many miners. Then it is, dare I say it, the golden period for the gold miners. They've been waiting a lot of years to get these kind of conditions, and here we are. But we've only been in these record conditions for about 2 quarters now. So it hasn't been very long. And so a lot of people still doubt, even though the gold mining stocks are trading right around their 5-year or in many cases all-time highs. But the stocks remain cheap as those earnings continue to rise. So I wanted to take a look at the best of the best gold miners now that we have all the earnings in. Who is looking the best for 2026 in terms of the highest Zacks ranks and the best valuations, plus the growth scenario? That is the best of all worlds. A Zacks number 1, a strong buy, a number 2, the buy, and then cheapness plus growth. Not many fit this criteria. So I developed a screen where I tried to search for this. And initially I put in the Zacks number 1s and number 2s. That gave me 856 stocks. Then I narrowed it down with the PEG ratio. Yes, I'm using PEG to look for value and growth. Remember, PEG is PE divided by the growth. PE, price to earnings. So we should get something that has both the value component and the growth, because I looked for 1 and under. So that's what gets you that rare combination of growth and value. And out of those 856 stocks, just 90 had a PEG ratio under 1. But we don't want just any companies with that PEG ratio under 1 with the top ranks. We want gold miners. And yes, you can search by industry, but don't look under gold. If you're on Zacks.com, you're doing a screen on there on the screening tool, and you put in industry and you're scrolling down, as I have done many times in the past, and I get to G and I'm like, where's gold? It's not on here. You have to continue scrolling to mining. So it's under mining dash gold, because there's many different forms of mining. And so if you scroll all the way down to the M's, you'll find mining dash gold. Put that into this very basic screen, and then you get 5 stocks. Yes, that's it. These are number 1s and number 2s, PEG ratio under 1. So these are the cheapest with the best growth scenarios. And then they must be gold miners. Now, what did I get in this out of the 5? You shouldn't be surprised. These are all large cap gold miners, with the exception of one that is a royalty and streaming company. So what's the difference? You have the gold miners who actually mine the gold and get it out of the ground. Then you have an aspect of the business that are these royalty streaming companies, where they just buy a portion of the royalty or the stream that's coming out of the mine. Many times these contracts are entered into with the big miners. Obviously, they would have to be, but it takes away the actual ownership of the mine from these companies. They don't actually own the mine. They just have contracts to get the benefits of the mine. It can be lucrative as well, but for this scenario, I want to stick with those who are actually doing the mining. So I didn't even look at, for very long at least, the royalty and streaming companies. So that left me with 4 miners, and I went with 2 that are Zacks number 1s and 1 that's a Zacks number 2. We had 3 that are the number 1s that were out of the 5 and 2 that are the number 2. So did I say 2 were the number 2? I'm doing 2 number 1s and then 1 number 2. And I'm going to start with the number 2 right now. I chose it, even though it was the number 2, because it is the biggest gold miner in the world, Newmont, ticker NEM. And just an aside, if you're doing a screen like this and you're just looking for these top Zacks ranks in the gold miners or maybe silver miners, whatever miners you're looking at with these low valuations, but plus the growth, you don't have to be a genius. You don't have to find some obscure small cap miner that nobody's ever heard of to make money right now with gold at all-time highs. You don't. And in fact, it might be better to be in the larger cap gold miners because it's difficult to mine gold. And there's a lot of things going on that can happen with costs, especially if oil were to rise. Also with geopolitical issues, the larger miners have more mines spread out across the globe so they can withstand if something happens at one mine. They still have operations at numerous other mines. The small gold miners might not have that option. So it's a little bit riskier for the small gold miners. Even if they're mining in the United States, you don't know when labor issues and other things could come into play. This is true with all the miners. So don't be a genius, as our chief equity strategist, John Blank, often says. With gold at record highs, no issue buying the largest gold miners and playing the record highs that way. So keep that in mind. That's why I chose Newmont, but all of these are large cap gold miners. Okay, so Newmont. Let's take a look on Zacks.com. What exactly is happening with Newmont? It does have the 2. And this is, as I said, one of the largest, market cap of $91 billion. They are paying a dividend. They are also doing share buybacks. This is what they're doing with their extra cash flow. So in the third quarter, they had record third quarter free cash flow of $1.6 billion. They're now paying a dividend of 25 cents a share for the quarter. And then they have the share repurchases also happening. They have reduced debt by $2 billion and they're near zero net debt position now. They have $5.6 billion in cash. So we're liking all of this. PE, as you can see on the screen right here, 14 times. That's very cheap. PEG is 0.5. And we have the low PE, but we also do have the growth. So this year, 71.3%. And next year, 22% is expected. Now, the thing with Newmont that some didn't like, even though they beat again, if we're looking at this price consensus and surprise, we had another big beat here because the analysts cannot keep up with what's happening with the gold price. But you can see the stock hit a new high and then is kind of lounging around. Gold is not making new highs. Like I said, it's holding right around the 4,000. Anywhere between 3,800 and 4,200 is where it's kind of hanging out. Nothing wrong with this after the big push to these new record highs in the third quarter. And I expect it to kind of remain like this until the end of the year. And then we'll see what happens in 2026. I do think there'll be further upside in 2026. But for now, again, anywhere around 4,000, any of these miners, as long as they're getting it out of the ground, are doing quite well on the free cash flow and they're able to pay down the debt. Now, the miners, it's not a cheap industry. It's a lot of debt, like with oil drillers. You have to, invest a lot in the mine and the costs can be high. And then you're buying other miners or trying to get new supply always. So costs, again, are high, and it's not easy of an industry. So when they get gold at these levels, they will pay down some of this debt, but then eventually it will come to you. If we see this continue on, even just around 4,000 an ounce for another quarter or two after this fourth quarter, where I think it will average around 4,000, then they will just have all this cash coming in. They will start paying some kind of variable dividends out, most likely, in addition to the basic dividend. Some may up their share buybacks. Again, they are paying down the debt, but many of them paying down the debt faster than they anticipated because the cash flows have been far better than they ever would allot for. And that will be true going into 2026. So again, Newmont has reduced all this debt, but one of the reasons why the stock still isn't moving higher, even though all these earnings estimates are on the rise, look at 2027 on this chart. It's kind of mixed in there with the earnings surprise, but it's up and a lot higher as well. So the analysts are not just bullish on next year, but looking for 2027 to also be quite bullish as well. But that's a ways out, so we'll see what develops there. But they did say about gold production, because this is about getting it out of the ground, right? Gold production for 2026 is expected to be in the same range as 2025. So much like with the oil producers, the street doesn't really like it if you're not increasing your production, even though earnings will rise with the record gold price, as long as you're keeping your costs down quite a bit. And then they also did say higher prices means increased profit sharing, royalties, and production taxes. That's if the gold prices remain elevated into 2026. So they do have to pay out on those royalty streams if they entered into contracts on those, which Newmont has. So that will come into play as well. But in the end, you don't want lower gold prices. You still do want the higher gold prices, but they're just kind of warning that these other costs are going to be impacted even with the higher gold prices. So in the third quarter, they saw 35.39 as their average realized gold price. That was up from last year's full year at 24.08. And so far through the third quarter, they're averaging 32.59. And again, gold is hovering right around 4,000 for this fourth quarter. So I'm expecting another gangbuster quarter for Q4. People are kind of not really caring much about the gold miners right now, even though they're hovering around their 5-year or all-time highs, but it's cheap. It's got the cheap PE, the cheap PEG. It's got the earnings growth. I'm expecting it into 2026. So now is the time to start a position, start dollar cost averaging, whatever you floats your boat on that. So Newmont, ticker NEM, is the first stock. Then I went to the Zacks number ones. Second one is Goldfields, GFI is the ticker. G as in George, F as in Frank, I. They're South African. Newmont is United States. That's also why a lot of people like Newmont, because it's headquartered in the US, so it's considered to be a little more stable. But Goldfields, also in South Africa, also one of the largest gold miners, 34 billion in market cap for them. Zacks number one rank. PE 12.3. PEG ratio, get ready, 0.26, as those earnings are now soaring. And dividend is yielding 1.7, which is a little bit more generous than some of the other ones we've seen so far. 2025 earnings. Let's take a look just at what the earnings chart looks like. They all kind of look the same, but Goldfields is a little more bullish for next year. So we have 136% earnings growth for this year, 48% still expected for next year. And some of this is because if they have a new mine opening, maybe they're going to be growing production. So you want to look for those things when you're looking for your gold miners. They did have all-in sustaining costs in the third quarter. That's the AISC. If you ever see AISC around a gold miner, that's what it stands for, all-in sustaining costs. And that declined by 10% quarter over quarter and 8% year over year. So this goes right to the bottom line. And in addition to rising gold prices, which they have no control over, they do have control over all in sustaining costs. And the lower they can get it, the more you'll see the earnings rise. So they are on track for 2025 full year production and cost guidance that they gave earlier this year. So that was all bullish. Net debt for them also fell 696 million in the quarter to just 791 million as of the end of September 2025. But at the end of the quarter and as fourth quarter began, they did close on Gold Road Resources for 1.45 billion. And they funded that by a bridge facility of 2.3 billion, but then they already paid back $1 billion on that bridge facility. So like I said, it's expensive running gold mines and buying new ones. So things are not cheap. Gold price was 3,468 an ounce in September. And they did increase their capital expenditures as costs rose. So keep track of all of these things. But again, we have that 48% growth expected for next year. That's why we've got the really low PEG ratio here. Shares are also doing what Newmont did. They hit a new high and now they've just kind of stalled there. Again, likely because of what's happening with the gold price. It's kind of stalled as well. So it's no longer on the front page of all the stories and the traders aren't really in it. But now is the time to accumulate when the shares are still cheap and they're kind of moving sideways here. We've seen this a couple of times with the gold miners so far in this cycle. And it's all normal. I don't expect the gold miners to go up every day like they were earlier this year. So get dollar cost averaging on these pullbacks or just, stalls where it's stalling out. You will get that dividend as well. And again, as the free cash flow comes in, these gold miners have to do something with it. So the shareholders going to be big beneficiaries. Okay, so that's Gold Fields. And then the third one I want to talk about is Kinross. KGC, Kinross Gold, again, very well-known gold miner. They are Canadian. So I just screened for these stocks. I didn't plan on getting a South African, Canadian, and American in the list of 5, but that's what happened. Kinross Gold, ticker KGC, number 1 rank, strong buy, and their market cap, 29.4 billion. And PE of 14.96, so just about 15, so a little pricier for Kinross. PEG, though, is just 0.4. So again, we're getting that earnings growth. Earnings, let's take a look. What is happening with the earnings? 139.7% for this year. We already know that. It's mostly done. Next year, 23.9, still expected. And so, again, that's why we got the low PEG. For their third quarter, record free cash flow of 700 million. They achieved a net cash position, very difficult to do for miners because, again, it's very debt-heavy type of industry. They have 485 million in net cash position right now. And that's not including this quarter, the fourth quarter. They did raise their dividend in the third quarter, 17%, and they increased their share buyback by 20%. So they had already done 405 million in share repurchases. They raised it to 600 million because the free cash flow was so good in the third quarter. Why not? Why not buy back some more shares at these cheap prices? So they also did an early redemption of 500 million in senior notes that are due in 2027. So they're not waiting around to see if things will still be good a year from now. They're just cashing in, getting the balance sheet really pristine, getting some of that debt off. They Also on the share buyback, they only reactivated it in April of 2025. So it's only been going for a couple of months here. But again, what do you do with all this cash after you pay down some of the debt? Maybe you do acquisitions, and these big miners are looking around for acquisitions for sure. And now they've got the cash to do it. 2026 guidance will be shared in the first quarter, so we're going to have to wait a little bit. Average realized gold price was $34.60 for them for the third quarter. That's up from $24.77. So you can see how good that was. But again, we are mostly averaging now as we head into the final month of the fourth quarter here. We are averaging right around that $4,000 an ounce level for the miners. So again, they were averaging 34 to 3,500 for the third quarter, and we had all these records. So I'm expecting another record quarter for Q4, but it remains to be seen. Are they getting it out of the ground? That's the question. And there have been hiccups with many of the miners, or there's been a decline in production, or they have a new mine that they've now commercialized and they're getting production out, but maybe it's not as fast as they initially projected. So some of that production is delayed. And all of those things can be a factor with the gold miners because it's only, revenue earnings only as good as what you're getting out. I know I keep saying that, but we've seen a lot of hiccups with the miners because it's not an easy industry, a lot of factors going in. And also something else to keep in mind for those miners that are getting a new mine, not one that they acquired, but a new mine completely, where they're opening it, there's a lot of costs in getting that mine ready and production and all of that. So costs will rise if they've got a big new mine. And for some of these big miners, the old established mine that still has a lot of production left in it, a lot of reserves are in there. Those are kind of the gold mine because once it's up and running and you get a system, basically, you can really lower the costs at that mine. So it's good to get new mines coming on board, but it will cost more. And a lot of the older mines that still have the big reserves are kind of the hidden gems in a lot of their portfolios. So look for those when you're looking for the gold miners as well. These old established mines that have quite large production still coming out of it. There's many other miners other than just these three. Again, there were only 5 on this list. The other ones, again, were the streaming royalty miner, which had a market cap of 6.3 billion. So not tiny, but not as large as these others. And it was Triple Flag Precious Metals. TPFM. T as in Tom, P as in Paul, F as in Frank, M as in Mary. If you want to check out one of the royalty stocks. And they are paying a dividend, which they did just raise. Right now we have a yield of 0.8%. So not even quite as good a dividend as some of these others. And then the other big miner on the list was Barrick. Not a surprise, ticker B for Barrick. I've talked about that stock many times in the past as well. There's only so many of these big miners, so we talk about a lot of them. If you want to just own the bulk of them, you can get that in the ETFs. The GDX is the large gold miners, so you'll get all of these stocks other than maybe the royalty one that I just talked about in that. And then you can get the junior miners in GDXJ. The juniors are in there. It's easy to buy those 2 ETFs as well and just get a basket of the gold miners. But if you're like me and you do like to own the individual companies and get those dividends rolling in as gold remains at all-time highs, then some individual plays might be warranted in your portfolio. And so here's 3 to consider for your short list for 2026. And let me recap those stocks again. We had Newmont Mining, ticker N as in Nancy, E as in Edward, M as in Mary, NEM. Goldfields, that's in South Africa. G as in George, F as in Frank, I. And then we had Kinross. They are in Toronto. K as in Kathy, although that could be C, but we'll just say it's K. G as in George, C as in Charles. KGC is that one. Then we had the, I just mentioned the triple flag precious metals, and that's T as in Tom, P, F as in Mary, F as in Frank, M as in Mary, TPFM, and Barrick rounds it up with just B as in Barrick, B as in boy. And as always, I'm going to be covering a lot of different stocks and what's happening as we finish the year. I'm also going to be looking into, are we heading into a recession? Are we in one in 2025? I'm bringing John Blank back on to answer this vital question and to look at what to buy for 2026. That's what we all want to know, right? After the kind of crazy up and down year, where should we be putting some of our cash to work in 2026? I'll be bringing it all to you here on the Market Edge podcast with a few more episodes left as we wind down 2025. So be sure to subscribe, get us on YouTube, go to zacks.com/YouTube to get the video portion on YouTube, get us on Amazon. We are on Amazon Music. We are on Spotify and, of course, Apple. You can get the podcast anywhere you get podcasts mostly, but be sure to get us somewhere. And I'll see you again next week with some more stocks.